guys, welcome to Beast Investing. My name is Luca. Hope you guys are having a great day as usual. Today we will be having our course number 3 of the Beast of the Market courses. Again, these courses are meant to bring you from an entry-level investor all the way to being able to put your first dollars into the market. Today we will be having our course about passive versus active investing. The whole goal of this course is to allow you to decide which one you would rather do and which one fits you in the best way. The overview, what we will be learning in this course is what is passive investing and what is active investing. So obviously they're opposites. What dollar cost averaging is. And we'll also be looking a bit at the returns of investing legends like Warren Buffett, Charlie Munger, and Peter Lynch, and finding out, if their strategy actually works and how we're able to replicate it. And we will finish it off by having a quick conclusion about which one actually suits you better as your different type of personalities. Nobody is the same, right? So first off, what is passive investing? Passive investing is extremely useful for people that are kind of in two categories. Either one, they don't have a lot of time to be able to put in a bit of effort that choosing individual companies require. Two is that they're not really interested in business and numbers, but they would still want to be able to retire comfortably with a good amount of money. So the main tool a passive investor uses is ETFs. Now, what is an ETF? An ETF is an exchange traded fund. What it is, it's a security that tracks an index. Now, the index itself it's a basket of stocks that follow either a very diversified portfolio or they diversify into specific sectors. So it's a basket of a lot of stocks inside of it. First off, we'll start with VOO. So VOO is a fund that tracks the S&P 500. The S&P 500 is a basket of 500 companies inside of this, the biggest 500 profitable companies in the United States. The VTI is the total US market. So there's much more. I believe it holds around 3,000 companies. So you have the 3,000 biggest companies that are public that are in this basket called VTI. VFH, for example, is a ETF that's a bit more specific. It has a basket of stocks, but it's specifically financials, mostly banks and credit card companies. So the financials of the US. Again, you could find ETFs for probably anything under the sun. Mostly we will look into American ones because that's where most of the money is. It's debatable, but we'll stick to that for simplicity's sake. And you also have specific purpose ETFs, such as the VYM, which is the high dividend index ETF. So this is going to incorporate the biggest and highest dividend paying stocks, as we learned the last time what a dividend was. And it's going to put them all in a basket that you could invest in to hopefully have a higher dividend yield than, let's say, a normal VOO. So first off, we're going to look at some examples. All right, so the first one we will study is the SPY. So this is another one. It's the same thing as VOO. It's just another company that makes the basket together. So SPY is again tracking the S&P 500, so the biggest 500 companies. So if you want to find out what these actual baskets have inside of them, you could go on Yahoo Finance, this is the most popular one, and you could go under holdings after you type in the ticker symbol. The ticker symbol is this 3-letter thing. Sometimes it's 3, 4, 5. I believe it's maximum 6 letters. So you type it into the search box and you will find it here. If you don't know the names of your indexes, a quick Google search will give you a couple of ETFs that you could invest in. Okay? In the holdings, we scroll down to the bottom and we could see the top 10 holdings, which represent 26% of the portfolio. 5.7% of the money will be in Apple. 5.2% will be in Microsoft. 3.93% is in Amazon, you see? And all these companies have they're the biggest companies, so they have the biggest weight inside of those indexes. Hence, the 500 biggest company, the biggest company is gonna take up the most amount of space in that basket. So if I buy one share of this for $418 USD, I am owning all of these companies and another 480 more on top of that. So the advantages of this is that if, let's say, Apple goes through a very rough time, let's say it even goes bankrupt, it goes to zero, very unlikely, but let's say it does, and let's say the economy is doing fine, so all the rest of the companies are doing okay, my downside risk is limited at 5.7%. So just because Apple goes bankrupt, all the other stocks will be able to carry it forward. It's a great way to limit the risk of mischoosing a company. So if I want to avoid choosing this bankrupt Apple, I could invest in 500 companies, and over long term, those 500 companies are going to perform very well, and not all of them are going to go bankrupt. Another example, we're going to look, I mentioned before VFH. So ticker symbol VFH, which is the Vanguard Financials Index. Remember, an index is what tracks a certain sector or a diversified portfolio. This one, in this case, is $90 US. And if I buy it for $90 US, these are the top 10 holdings. So as you can see, they are all banks. We have JP Morgan, Berkshire Hathaway, that's technically a holding company, investment company type thing. We have Bank of America, Wells Fargo. We have some Charles Schwab, which is a bank and brokerage, and American Express credit cards, right? So these are all financials in the US, the biggest ones. So if I wanted to focus on, let's say I'm bullish, meaning I believe the banking sector will perform well, I would invest in this and I could hold it for a long term, and I don't have to pick and choose what company in that sector is going to do well. They're in aggregate going to do well if that's what my thesis is. Another example is what's called JETS. Now this one is a very, very specific fund. For $26 USD, you invest in JETS. Now what this will show you is that there's 10 companies that represent 66. You see that these are the majority holdings. It's very specific. And it's the airlines of the US. So you have Southwest, American Airlines, Delta, United Airlines. All these airlines are in this ETF. So if I'm bullish on the airline sector, I can invest in this ETF, which is JETS, J-E-T-S, right? So now that we've seen a couple of examples of what these passive funds can be, we're gonna look at why would you invest in these passive funds? Passive meaning ETFs. That means that you don't have to actually choose an individual stock. You could just bet on a diversified sector. The main goal of this is to get it out of your head to give your money to the bank and to the bankers and investment bankers. Wall Street, which is known as the powerhouse of the US, maybe apart from Silicon Valley, but Wall Street, New York is where in everybody's head, they are full of money and they're super rich. Ask yourself, why are they full of money? Are they full of money because they made everybody in the US tons of money, or because they're collecting their checks and their fees and their commissions? The answer is fees and commissions. They have tons of money because people are not educated enough and they're maybe a bit too lazy to research about how to put their money to work for no effort. It doesn't take a lot of effort to passively invest. Another reason is that index investing actually outperforms most fund managers. This is an anecdote, but I have a couple of family and friends that have been investing with bankers forever now, and they have consistently underperformed the S&P 500. Let's say, well, we'll take the ETF SPY, for example. They've consistently underperformed. That means if they put their money in SPY instead, which takes 5 minutes to buy, it doesn't take a lot of effort. If they would have put it in SPY instead of the fund managers, they would have made much more money and grew their wealth exponentially more, especially across 20, 30 years. Now we might be asking ourselves, how is it possible that index, which sounds so simple to invest in just the whole US market, how does it outperform fund managers? This is a crazy concept to think about, that people that are professionals, that have gone to school, that have dumped hundreds of thousands of dollars in education, are being outperformed by the S&P 500. The main reasons are, number one, emotions. Emotion is your absolute worst enemy in investing, because when you're supposed to be buying, when other people are selling, but everywhere you're gonna read in the newses and everything, you're gonna read, oh, it's the end of the world, dump your shares. Your brain actually starts to go along with the wave. You're supposed to do the complete opposite. So emotions will make you make irrational decisions that aren't based on the numbers, which severely affect your returns. Another reason is the trendiness, inflow, and outflow of money. Or trendiness or inflow and outflow. And let's say there's one fund manager that everybody's saying he has the golden hands. Everything he touches turns to gold. Everybody starts throwing money at him. What this means is that he's going to have to purchase shares at a high price. For example, he started making money when the stocks are low. He invested, the stocks went up, and now people are throwing money at him when stocks are up, meaning he has to now purchase them at a higher price. Because he purchased at a higher price, we've learned this in the past courses, what happens when your PE goes up and the price you pay goes up? Your returns go down. So it's a self-fulfilling prophecy that the fund managers that do the best for very short term, a year, months, they get massacred long term because they're gonna have to purchase up and lower their long-term returns, as well as when people cash out. So when people are fearful, they cash out and he has to sell low. So it's the complete opposite. So what fund managers are forced to do sometimes is to buy high and sell low, which doesn't make sense. That means you're losing money. The last example is that the managers of the funds will always have their fees and their commissions. This is how they are rich. They charge sometimes up to 1% of your either gains, or just by having money with them, they could also like take a fee from there. So sometimes hedge funds, they do 2% and 20%. So they take 2% per year of the capital you have with them, and they take 20% of the gains. This has an astronomical effect on your long-term returns. As we saw before when we were talking about compound interest, we are seeing that a couple of percentages makes a huge difference. As you can see here, they're taking 20% of your gains and 2% of your capital, which is decimating your long-term wealth. So as you can see, this is your typical fund manager smoking your money. He's having a great time. He's collecting all the fees. It's not even his own money he's managing. He's just taking advantage of people's laziness and miseducation. And yes, they are rats. And I personally do not like investment bankers, especially investment bankers trying to bring companies public, meaning they're bringing them from a company that has one owner to being a public company, which means that anybody can invest. Their job is not to be an investment person, it's supposed to be a salesman. They're trying to sell you the stock. That's why in the market you have what's called IPOs, so initial public offerings. So it's the first time a private company becomes public. Those companies are going through the roof always, okay? So you have companies, off the top of my head right now, Palantir, you have Peloton, you have all these new companies that are being hyped up by these fund managers because they get their fat fee. And who foots the bill when everything crashes? The average retail investor like us. The next most important concept when it comes to passively investing, it's a phenomenon called dollar cost average. So what this is that you are continuously depositing money into your brokerage account and you're continuously buying more of that same fund or ETF. You could also do this with stocks. So you're constantly putting money into your account and you're constantly buying the same thing, the same stock or security, no matter what the price or time is. This is super important. This takes out all your emotion out of investing. Remember, emotion is your worst enemy. We just want facts. What this means is that while you purchase, no matter what price and time, what you see is that we have a smooth out line. So first of all, this is just the blue graph is the S&P 500 in the past, 25 years or so. So what we can see is that it goes up, down, okay? It's all over the place. This is the nature of the markets. When it's going up, everybody's too excited. When it's going down, people are fearful for their life. All of these vertical lines are examples of when you would buy. Obviously, you'd buy a bit more often because that's every like 2 years, but I didn't want to make a million of them to have a clear graph. So you'd be buying, let's say every month. Every month you buy one more share of SPY, for example. So if you buy every month, you end up having an average that follows this long red line. Your returns are going to be much more stable and up creeping with less of this volatility and crashes and everything. As you buy up, obviously that's kind of worse for your long-term returns, but it's also forcing you to buy when it goes down, which is much better for your returns, which evens out. And it evens out and it goes nicely straight up over a long period of time. It takes out all the emotion, which is your enemy. So again, advantages of dollar cost averaging, it smooths out all crashes. When the market crashes, you're buying more, which is boosting your returns. You will outperform most managers. It will also help you sleep at night. You're not betting on, is it going down tomorrow, the stock market? No matter what, you're buying every month continuously, no matter what you see on the news. So again, it increases long-term returns and it can be fully automated. Now in Canada, we don't fully have this yet where everything's fully automated, but in the United States, I think you could do it very easily fully automated, where you have auto deposits and you have auto purchasing as long as the money comes in. The next thing we will be looking at is active investing and what it takes to beat the market. That is your whole goal, is that you want to beat the S&P 500 or whatever index you're trying to beat. So as you can see, passive investors are going to take advantage of the 10% per year that the stock market has returned. The S&P 500, for example, has returned around 10% a year with dividends, plus or minus, over the long term. So the passive investor is just following that market's wave. Your goal as an active investor is to try to beat the market and hence accumulate even more wealth than the passive investor. Squeezing in an extra 2 to 5% a year, if you could, with low risks though. Now that's the problem. If you outperform the market over the long term by 2 to 5%, you are a very good investor, and one day you might even be in the book of legends after 50 years of doing that. Now, the chances of this happening are very low, especially people online. You will see this everywhere where people are like, it's easy to beat the market. Last year, the market did 40%, which is extremely high. And they did, let's say, they made 200%. Now, this may sound crazy, and they're like, they're the legends. No. Do this over 40 years straight, and then come talk to me and show me how good you are at investing. It does not exist. What the main equation of this is big gains with low risk. Because what happens with that guy that made 200% last year? What if next year it falls 80% because he had super high risk? Guess what? My slow and steady, let's say 15%, I made more, but let's say 15%, will actually beat him over the long term because he had that massive drop and he lost a lot of his money, which ruins his compounding. Remember, we never want to lose money because that ruins our compounding over the long term. So right now, we're going to look very quickly at the historical returns of these legends. As I said, market's 10%. I personally aim for 15%. If I'm able to pull that off over 30 years, it's going to be astronomical amount of wealth. So first off, this is from the annual shareholder letter that Warren Buffett posts every single year. This is specifically for his Berkshire Hathaway's company performance. So it's a holdings company. So he has investments. He buys companies outright. But in general, he's considered an investor. So as you can see, he started investing in 1965. That is before a lot of people's parents were born. So it's been a long time. But this just goes to show you that consistent outperformance of the market over the long term is huge. And we're talking about Warren Buffett. If he never donated a cent of his money already, he would be at $140 billion. It would be probably the richest person in the world, alongside Bill Gates, because Bill Gates has also given out a lot of his money. At the bottom here, we have the compounded annual gain for 1965 to 2020. So that is ultra long term. He has made 20% compounded annual gains compared to the market's 10.2, as we said. Now, this is ridiculous. He doubled the market's performance over 60 years. This is never seen anywhere else over the long term. So he obviously has something that people don't get. And he's been teaching people forever through his conference calls. There's a lot of value. I really encourage you guys to go look at them once you have a basic knowledge of terms. He spreads tons of knowledge, yet people don't listen to him. People call him a dinosaur. People call him, he's old school. He won't make money these days, right, with technology? This number begs to differ. There's been a lot of technology since 1965, by the way. And it's not the first time there's tech that comes, yet he still outperforms everybody. So I don't like when anybody disrespects Warren Buffett or all these investing legends saying they're dinosaurs. Yeah? They will not be able to make these kind of returns long term. So this is another legend of investing. His name is Peter Lynch. He was running the Fidelity Magellan Fund. He didn't do it as long as Warren Buffett. He did it from 1977 to 1990. So that's 13 years. So not as long as Warren Buffett, but 13 years is a good measure of time. As you can see here, S&P 500 did times 6 in that time, which is a very good performance, by the way. Times 6 in your money in 13 years, that's very healthy performance. What's to look at is this blue line. This blue line means he did 28 times your money. He vastly outperformed the S&P 500. I wouldn't consider him as much of a value investor per se as Warren Buffett, but he had the exact same moral compass as I would be teaching you, because I've learned from all of these people. I've read all their books, and I'm just passing on the information maybe a little bit simpler way. This is Charlie Munger's returns. Remember, he's like the number 2 in Berkshire Hathaway, so he's very close with Warren Buffett. They work together to run Berkshire Hathaway. He has annual returns of 19.8%. This is what's interesting. This is while the Dow Jones and the S&P 500 made almost 5%. So he quadrupled the performance of these funds by actively managing his money. So these are the advantages of actively, is because you have much greater potential to make money than what the market does. If you follow the market, you will do absolutely fine. This is what's important to know. You will do better than most investors even, if you follow the S&P 500. So in short, I'm going to teach you guys what exactly those legends of investing do to beat the market. First thing it takes is in-depth analysis of financial statements. As I said in a previous video, 70% of investing is knowing numbers and learning those numbers and knowing what to do, how to say, is that number good or bad, okay? So these are learned in financial statements. The next would be the strategy and discipline. These kind of go together. So your strategy has to remove all emotion out of investing. This means that I have to stick to a plan. Let's say I only invest in companies under 12 PE. I don't do this. But let's say that's my strategy. I need to stick to that strategy consistently, if it makes sense, obviously. So if I stick continuously to that buying under 12 PE and I sell it when it goes above 16 PE, let's say, I will do fine in the market when we're talking about good valuation metrics and, of course, choosing good businesses. We've talked about this in our previous course also. The next most important thing is patience. It cannot be said enough that patience and time is your best friend. You do not want to be in a situation where I'm buying a stock, it doesn't go up next week, and all of a sudden I sell because it's not making me money. That's not how it works. People invest at the peak of markets, everything crashes. Yet if you would have held on, if you would have sold at that crash, you lose out money. Little did you know it's gonna go right back up if it's a great company. Now that's the common denominator, is you have to invest in great companies that will recover. And finally, I would say it's thinking for yourself. What's hard to comprehend is that right now we are in the middle of the largest bull market in history. Everybody believes that everything is rosy, everything is going great, everything is only gonna go up in the future. This is probably a good sign that the exact opposite is gonna happen. Now, I broke my crystal ball, unfortunately. I wish I was able to share this with you, of when exactly the market's gonna crash. My crystal ball is broken, I cannot tell you this. What I can tell you is that eventually the market will crash. When the market does crash, all of a sudden everybody starts thinking the opposite. Everybody starts thinking, oh, stocks are gambling, it's all a scam, it's a pyramid scheme. This is what's going to be circulating when the stocks crash, as well as people saying, oh, the economy is finished, we're all gonna be out of jobs, we're all gonna be starving. You hear these things in big recessions, as in 2008, people thought it was actually the end of the world. So nobody was buying stocks in the crashes, which is counterintuitive. You're supposed to be buying when everybody is selling. Good companies, of course. There was companies that went bankrupt, and if you would have not done your due diligence with financial statements, you wouldn't have known that the company's going bankrupt. Alright guys, so in short, what we learned today is that most people should be investing passively. Most people do not have what it takes, and this sucks to say, but not everybody has what it takes to beat the market. It pretty much means you need to take emotion all out of investing and focus on having a system that works and a system based in reality with actual numbers, not just imaginations and projections. It has to be based on realistic numbers. We also learned the magic of dollar cost averaging. Remember, that is when you buy systematically, and that smooths out all your crashes and stuff. And even if it crashes, you're buying more no matter what. It goes up, you're buying more. Over the long term, you will be able to retire very nicely just by doing that. And finally, we also learned what it takes to beat the market. It's obviously not easy to beat the market, or else everybody would be Warren Buffett. Nobody has the money Warren Buffett has, and it's for a very good reason. Here I have a graph attached of growth of $10,000 over 20 years from 1995 to 2014. As you can see, this is what the average investor has returned. They've returned 6% over 20 years. How is this possible? Look at the S&P 500. 66,000. So tell me again, people think it's so easy making money, yet look at this graph. This graph begs to differ. And why is this graph so ugly? It's because in between this 1995 and 2014, there was two massive crashes. We had the dot-com bubble in 2000, where any company that had .com next to it automatically was through the roof and going to the moon, as we see these days. Or there was the 2007 crash where you had the real estate bubble and everybody was buying real estate. And everybody and their grandmother was buying real estate because real estate only goes up, right? That was what everybody was thinking then. Right now, everybody believes stocks only go up, and people are buying a lot of very bad stocks. I'll put it nicely like that. And here you have Berkshire Hathaway absolutely smoking the S&P. So people always say oh, he's dead, he's a dinosaur. Nobody could smoke the S&P as Warren Buffett has. All right, guys, so we've reached the end of the video. Please don't forget to decimate the like button and subscribe for more courses. I would really appreciate it. It helps the YouTube algorithm push my videos out there a little bit more. And next video, we will be looking at the specifics. Now we're gonna get into much greater detail of how to beat the market and how to analyze financial statements. That will be in the next course. Stay tuned, guys, and have a great day.